Good afternoon and welcome to the sixth webinar in the NYBB's Middle Market M&A series. Today's webinar is titled Exploring Growth Through Acquisitions. My name is Lou Della Prida. I'm a managing partner at the NYBB Group, and I will be the moderator for today's session. Over the course of the next hour, we're going to learn the benefits of growth through acquisitions, what buyers need to consider before embarking on an acquisition, the pitfalls that buyers should be aware of, and how you can ensure a successful integration. We're pleased to have three very interesting speakers here, and I'll give them an opportunity to introduce themselves before we kick off the webinar. First up is Pattie Ehsaei from First Bank SBA. Welcome, Pattie.
Thank you so much. Thank you for having me, Lou. Really appreciate the opportunity.
Can you introduce yourself real quickly?
Sure. I am Pattie Ehsaei, and I work for First Bank. First Bank is one of the top SBA lenders in the country, and we really focus on providing financing for mergers and acquisitions, partner buyouts, and expansions. As far as my career is concerned, I started out as an attorney, a criminal prosecutor, and then I just sort of fell into financial services in 2001. And in financial services, I have held various roles as a regional manager in business banking group at Wells Fargo. I was also in investment banking and raised money for private equity funds. And I went back to commercial banking and was a regional manager at Union Bank for about 3 or 4 years. And then since 2006, I've been focusing specifically on financing mergers and acquisitions.
Thank you so much, Pattie. Next up is Anthony Citrolo from the NYBB Group. Anthony?
Thanks, Lou, and thanks for hosting. Welcome to everyone. I'm Anthony Citrolo from NYBB. I'm a partner here. I started the company back in 2003. We focus on lower middle market business. It's $5 to $50 million in revenue. We have a small business and franchise division as well. We help clients looking to exit, looking to grow through acquisition.
Thank you so much. And then Glenn Friedman from Prager Metis.
Thank you, Lou. I really appreciate this opportunity. I appreciate the other panelists. My name is Glenn Friedman. I'm the CEO of Prager Metis International. I guess we're the 39th largest firm in the country. We have 16 offices throughout the world. We provide a multitude of financial and advisory services, some of which are merger and acquisition services. And we've grown quite a bit through merger and acquisition. So I have firsthand experience as to what mergers and acquisitions can mean to an organization. Thank you.
Excellent. Looking forward to getting your perspective. So the first question, jumping right in, are what are the benefits of growth through acquisition? I thought I'd start with you, Anthony.
Thanks, Lou. You know, we've been speaking often to folks about growth through acquisition, and it's not a new concept. Of course, it's been used by Fortune 1000 companies for years, private equity firms for years, and then other companies now, especially in the lower middle market, who look to grow their company. And you know, the question we always pose is, how does a company who's, let's say, has $20 or $25 million in revenue get to the next level, get to 30 or 35 or 50 million? I guess the question really is, how do you grow your business? Some folks, it's organic growth, and I think organic growth is great. And some can actually do it through the acquisition of another company, which makes sense relative to what your business does and what your needs are. Of course, the real benefit is acquisition can be more immediate, adding top line revenue, adding bottom line revenue. It can add some talent and bring you into some new markets. So I think those are some of my high level kind of looks at the benefits, Lou.
Excellent. Thank you. Thank you, Anthony. And Pattie, what about from your perspective?
I think one of the most impactful benefits is to be able to capitalize on the synergies between the companies. So hopefully that the company you're buying, you have enough synergies with to where you can potentially cut your overhead. And if you can cut your overhead, you increase your margins and increase your profitability. So that's really huge when obtaining financing. Also, you properly have similar industry experience, if not the exact industry experience of the company that you're buying. So when you're obtaining financing, there's not going to be a question as to whether you know how to run this type of business or whether you have industry experience. So really, the synergies are important as far as how you're going to run the company. And also, on growth acquisitions like this, potentially you can obtain 100% financing depending on the strength of the acquisition company that you're buying. So you may be able to, not have to put any money down and get 100% financing.
Excellent. And Glenn?
So let's just look at organic growth, if you will. Even organic growth is multiplied out if you also grow by acquisition, because any of that organic growth that you're going to have, or those cross-selling or cross-marketing opportunities, are going to be exponential if you're a larger organization. But mostly what you want to do is you want to enhance your strengths, and you want to mitigate your challenges by acquiring a company that might have strengths in an area that you don't, or might have a geography, or might have a product mix that you don't have, but a product that could be cross-sold to your client base. You're also gaining a client base that you could sell your services or your products to. The benefits are just endless as to what comes from merging in the right target company. There are certainly economies of scale. There's talent acquisition, especially in a tight talent market. Right now, maybe that's not the case, but just 3 months ago, talent was very hard to come by. Also, it could be a defensive move. In our industry, perhaps there's a product line that you don't have that your client needs, and if they go to some other firm to meet those needs, you could wind up losing that client, not because you're not doing a good job, but because the client might say, hey, you know what? If I can just have one-stop shopping or be working with one relationship person, it's more efficient for me. So it could be offensive, it could be defensive, but there are so many gains to be had by mergers and acquisitions.
Excellent. So we just looked at what the benefits of growth through acquisition were. Let's look at now what buyers need to consider before embarking on an acquisition. Can you kick it off again, Anthony?
So I think there are a lot of things that you need to really consider. We have found that it's interesting. We found that folks who've never made any kind of acquisition are really reluctant to do it and don't know what really to expect. So if you are a novice buyer, I think you really need to consider the right advice and the right counsel so that you, in fact, don't make a mistake. I think buyers need to consider what their needs are and what their goals are. For instance, we have a client who's clearly he's in the HVAC space and is clearly in need of talent, and he has come to us and said, "Look, I would buy a company even if it's not profitable." He goes, "Really, just to get the talent, I can move the business into a profitable arena, but I need the talent badly." So I think you have to look at that very clearly and see what your goals are. Because from a financial standpoint, you have to be prepared. From a management standpoint, you have to be prepared. And you really have to know how really the process goes and how to get it done and what your ultimate goal is. And the other thing I like is you got to also think about, what your message is going to be to your organization. So I think, buyers got to consider all of those things. It's not just kind of pulling the plug and making an acquisition and saying, okay, we're going to take in another $5 million of revenue.
Excellent. Before I go to Pattie, let me, I forgot to remind everybody, once we go through the 4 learning objectives, we're going to open it up for Q&A. So if you have a question, please feel free to click on the question mark up at the top right, where it says live chat, and we'll field your question shortly after we go through the learning objectives. So Pattie, from your perspective, what do buyers need to consider?
One of the most important things from a lending perspective is that the company has current and reliable financials, and that these financials have been prepared by a CPA. A lot of times you'll have company prepared financials and they really are not reliable. So make sure that the financials are in place and they have financial controls. And also when you're looking at a company that has a lot of add backs, let's say a seller is running a lot of expenses through the company that you would not or should not be doing, make sure that if you want those add backs, that they're easily validated. Because if they're not easily validated, we're not going to add those back as lenders, and it's really going to impact your cash flow. So just make sure that if there are add backs to be had, speak to a lender and see if those add backs are going to be acceptable and how that's going to impact cash flow.
Excellent. And Glenn, what about from your perspective?
Well, since I am a CPA by trade, I certainly agree with Pattie that the financials are important. But for me, you do need to start with a plan. You need to identify what your strengths and weaknesses are and strategically what you're trying to accomplish. And then you need to look for targets that achieve those goals. And that's not to say that opportunities don't come along that you shouldn't hear about, listen to, and consider. But a good thought out plan on what your strengths, weaknesses are, and what it is you're trying to achieve. For instance, Anthony said, I need skilled, talented people. If that's your goal, you need to look for an organization with skilled, talented people. If you're in the Midwest and you want to be in the Southwest, you need to look for an organization in the Southwest. So those are all things. It could be geography, it could be people, it could be product line. You really need to understand what you're looking for. But more than that, and more than the financials, it's all about people. And it's really important to understand the culture that you're trying to assimilate into your organization. It could bring down an organization. So, you know, at our firm, we actually do a culture due diligence along with a financial due diligence. It's really important to us not to try to fit a square peg into a round hole. And at the end of the day, it's all about the people.
Excellent. Okay. So you mentioned culture, which could be both a pro and a con. So we've looked at some of the things that you need to consider before you embark on an acquisition. Let's take a look now at some of the pitfalls that a prospective buyer might encounter along the way. Anthony?
Yeah, and you know, I had a question, Glenn. I had a question. So I was curious, and the audience probably is curious. So how do you actually do the cultural type of assessment? You know, how does that work? Because we see that as one of the biggest pitfalls, and maybe it's a good way to kind of get a little perspective from somebody who's done it often.
So our cultural survey, well, let's start at the beginning. In the beginning, when we were sort of novice at this, it would be guttural, right? I would meet the owners of the company, I would meet the leadership team, and you know, sort of instinctually, I would determine, you know, whether this was a right fit for our organization. But as you grow, you sort of have to get a little bit more scientific about it. So we now have a team that does a culture due diligence, and part of their due diligence is to do things like look online for reviews and complaints and employee complaints, and you know, look, everybody has complaints, so we weight those complaints, but we also go back to management and we ask them about them, and we weigh their answers. We do get to know leadership and the owners of the company, and then we've just instituted a new program where we have a culture survey that is anonymous and goes directly to the employees of the company. And so I don't know that that's the beginning and the end of all the things that you can do from a cultural standpoint, but I think it's a pretty good starting point. Many of us survey our own employees to make sure that we're maintaining the type of culture we want to maintain. And so we want to see that coming in, these organizations philosophically fit into our organization.
That's interesting. So, Lou, you had asked me about pitfalls, and I wanted to hear from Glenn about that because we see that as a real issue. But I think some of the pitfalls I find are sometimes there's the owner really who's of the acquiring company really wants to make the acquisition work. So they kind of push the envelope in a way where they almost want it to work so badly that maybe they overlook a few things. So I think one of the main things that people really have a pitfall is how they evaluate the employees and the talent. The question is who are the employees? What is their talent level? And question is, will you retain the talent, and how does that impact the business? I think one of the other pitfalls are, really what are the synergies, and how much bottom line revenue, how much bottom line savings are you going to have as a result of the synergies? The other thing we find is what really are the implementation costs that you're going to incur? I mean, there's software to consider, there are processes, there are CRMs to consider, all sorts of accounting. When you're looking at somebody's organization chart. So I think some of the pitfalls could be big. And the last thing is, I think, customer and client expectation. You want to make sure that the combined entity and as you're going can actually meet their expectations, and your organization still has to deliver, amidst a combination that could be somewhat disruptive. I think that's important.
Excellent. And Pattie, what about from a legal lending standpoint?
From a lending standpoint, especially an SBA standpoint, one of the pitfalls is that you want to make sure that the seller is going to exit the company within a year. Typically, you're buying a competitor, the seller is not going to want to stay on. But I have seen instances where the sellers of the company plan to stay on, and that was part of the management. And if that's the case, if you're going to get SBA financing, that will make the financing ineligible. So that's something to look out for. Another pitfall is something that Anthony had mentioned. If your company is currently profitable and you're buying a company that's not profitable, you have to make sure that, as far as a lending perspective, that your current company's cash flow is enough to sustain the cash flow of the other company to service the debt. So the company that has a shortfall in cash flow, the other company has to make up for it. So if your company is not profitable and the other company that you're acquiring is, the company that you're acquiring has to make up for your company as far as the cash flow for the entire business together. And that's something that a lot of buyers don't consider and just think, okay, well, I'm going to buy a business and I'm going to make it profitable. Well, to obtain financing, that business has the cash flow for the loan on its own. And if not, then the cash flow has to come out for your business.
Yeah, and we had spoken on the pre-call. You had also mentioned that they should think through what is going on through the management team. Was that just strictly for the 12-month period, or was that an important consideration
period? We've talked about it a lot, and that's why I didn't necessarily mention it. But yeah, the management team is so important, because what is the plan, right? So how are you going to manage the current employees of the company that you're buying? Are you going to be laying them off? Are they necessary for the transition? Are there any licenses actually that the company that you're acquiring needs that you currently don't have? If that is the case, who's going to hold that license? Is there someone in the management company that's going to hold that license? So those are all, very important factors in considering just the employees and how the synergies are going to go between the employees of your company and the company that you're acquiring.
Excellent. And Glenn?
I would say that don't overpromise and underdeliver, right? And I mean that inside your company and outside. So if you're responsible to a board and supporting a certain transaction, don't oversell it, because it could come back to hurt you in the long run. If when you're talking to your bank or whoever's going to be financing the deal, again, don't oversell it. Be very realistic about what you're getting into. There's no room for being delusional or for kidding yourself. And to Anthony's point, I've seen it over and over again. People get the taste of getting the deal done, and they want the deal, and they want it so bad that they overlook signs that they shouldn't overlook, because after the deal is done, every one of those things that you ignored is going to come back in, 2 and 3 times what it was like before, when you should have been paying attention to it. In addition to that, most deals, you try to think everything through, but at some point in time, something occurs that you need to deal with, and you're going to have to deal with it in the future. So those are the issues.
Excellent. Thank you. Okay, learning objective number 4. How can you ensure a successful integration? Anthony.
So I'm not so sure you can insure it, Lou. I think it takes some good observational skills. It takes a good plan. It takes some cooperation. And I mean, because we've seen situations, and I think you have to really first and foremost, kind of keep your ears and eyes open. Oftentimes, when we see an existing owner selling his company and he's remaining on as the operator of the company or is remaining off a transition, his heart, his life is not in it. And I think it may show up either during integration or afterwards. I also think you really have to get the advice of pros who can help you with the integration, because it's really it's a skill and a technique that if done incorrectly could really kind of put your complete investment at risk. I think another thing, you really have to avoid disruptions in your primary company, right? You have to continue business as usual and not make that secondary to the actual acquisition you're doing, because ultimately you'll end up with an organization, I think, that'll be kind of damaged in a lot of different directions. And finally, I may have said this already, but listen to people who are your advisor in terms of what they've done, how they've done it, and realize it's probably not going to go as you planned, and you're going to have to, maybe make some adjustments along the way that you probably didn't expect. You probably may cost you more money than expected. Probably have to build it into the process, and also just realize that your time frame is probably not going to be the actual time. The time frame you planned is probably going to be a lot longer, a lot shorter than the actual time frame.
Excellent. And Pattie?
Uh, Really, I think this kind of goes back to the last question, is that the management plan. What is the management plan in order to keep the companies successful or make them even more successful? Who are you going to keep? Who are you going to lay off? And who do you need to hire? And you also need really a buy-in of the management plan. So the people in your current company, they work for you. They probably have a lot of confidence in you, but you have to make sure that the company that you're buying, if they're keeping their employees, that they have a buy-in into the strategic initiative of the business altogether, and that they're all going to be rowing in the same direction to achieve your goals and your objectives.
Okay, excellent. And Glenn?
I think that all your points are extremely well taken, and honestly, I think rowing in the same direction is the most important thing. Building consensus right out of the box is the most important thing, and making sure both teams are on the same page, and that's not easy to do. You have to create an environment of inclusiveness. I would say that the earlier you get started with any future planning, the better.
Okay, excellent. So that concludes the 4 learning objectives. There are a couple of questions there that I'm going to read off in a couple of minutes. I encourage you to submit some questions for the audience. I'm sorry, for the panelists at this point. So the first question came from Peter Whalen, and the question is, buying a company to gain talent. That was mentioned before. How is the buyer guaranteed that employees of target companies will remain after the acquisition? Any one of you can handle. Anthony?
So, look, I think there's a few ways to do it. We always recommend that there's some kind of stay agreement or some kind of structure that is put in place with the existing employee or the person who has the talent. This way, a couple of things. Number one, they know they're going to be compensated from a financial standpoint. Also, they are told that they are a valued employee, and I think psychologically it has some benefit there. And I guess it's very difficult to force somebody not to quit, right? But we found that if somebody signs an agreement and actually is getting paid for it and is part of a new company, sometimes they look at. We have to really kind of. Some of it is people skills, right? And sort of letting them know that they are valued and they are important, in that we want them to stay with the organization. Here's what we're doing to do it. I guess Glenn probably had a lot of experience with that with some of the folks on the accounting side.
Yeah. Pattie or Glenn, you have anything to add?
I think that an employment contract is really important, especially if it is an essential employee to the company and running the business. So if this person is really essential in the company and its success, whether it's, they're the ones that have been running it for 20 years, and you're not really sure how to run this new company, or if they hold a license that is necessary for the company. I think an employment agreement is really important. But really, again, as everyone has indicated, just to make sure that they want to be there and that they share the same vision as you do, because an employment company can keep them there, but if they're not sharing in the same vision, then they're not going to do a good job, period. And the success of the company is not going to be where it needs to be.
Okay, and Glenn?
I would echo Pattie's sentiment, and that goes back again to culture. It goes back to the types of people that you have joining your firm and who you are. It's all about people. I mean, we don't have robots running these companies. So if you have a key employee that is important to the success of any acquisition, you need to really sit down and make sure that you have an agreement with that person and that they're part of the team and on board. You're making a big investment, and you're not just investing in a company with goodwill. You're investing in the people of that company.
Yeah, excellent. So Peter had another question. It was, any comments on acquisitions that involve real estate? Give me 1 second, I just loaded the question.
I can start if that's okay. So in acquisitions that involve real estate, that can be really beneficial, and here's why. If the real estate that you're acquiring is worth $1 more than the cost of the company or the purchase price of the company, you can amortize the entire loan over 20 years. So that's really advantageous, because that's really going to help your cash flow, right? So if real estate is involved and it's worth $1 more than the purchase price of the company, you can go out 20 years on the entire loan. If the real estate is worth less than the purchase price of the company, you can still benefit from it, because then you'll do a blended amortization. So an amortization on the business acquisition loan is 10 years, the term of an amortization, or 10 years. And on real estate is a 20. So you can go out, and you can blend the amortization, come to 15 or 17 year.
Fantastic. Anthony?
Well, yeah, we found in most cases, we've done transactions where real estate was owned by the business owner, and in most cases, especially on the private equity side, they have no interest in buying the real estate. So it has to be understood up front that if the owner really wants to sell the real estate, depending on who the buyer is, that may not be part of the process, and they may end up being the landlord for that real estate. So I think that it could be beneficial if you're on the borrowing side, but we find a lot of folks don't feel that's a great use of capital. They'd rather not tie themselves into a piece of real estate because that's not their primary business. The first thing. Then we've had a lot of situations, especially in the New York marketplace, where the real estate really is the most valuable asset. Okay, and the business itself is a great asset, but it doesn't really make sense to continue that business in the location. So if it's not location dependent, we've done some very interesting transactions where the business gets sold, it gets folded into the existing company, and the real estate gets sold separately to whether it be a developer or someone else who needs it. So I think most of our acquirers are not typically looking for real estate. We do have one instance out east where, of course, there's a warehouse and it's a distribution company. They need the real estate, and even in that case, the buyer of the business is not necessarily interested in purchasing the real estate. And for tax purposes, a lot of the sellers would rather keep it as another one of their assets that they didn't sell. They don't have to pay taxes on. They can continue to collect rent on. Hope that answers the question.
Yeah, excellent. Glenn, do you have anything to share here? Did any of your acquisitions involve real estate?
From time to time, we do get involved in acquisitions with real estate, and that could cut both ways. I want to point out that no two deals are the same, right? And in some cases, maybe you want the real estate, and in other cases, you don't want the real estate, because as we said in the beginning, we're looking for economies as well. And maybe you have enough plant that you want to roll the two companies in together. Maybe it's in a different geography and you don't, and you want the real estate. Or maybe the owner wants to maintain the real estate and sign a fair market value lease with you. So no two deals are the same, and you just have to, again, start with the plan, know what you're looking for, and go from there.
Excellent.
May I interrupt really quickly?
Yeah, sure.
I'm sorry, I think I said you can go out 20 years. It's actually 25 years on the entire loan. My apologies. I said 20 and I meant 25.
Okay. Okay. Excellent. One more question from Peter. Thank you, Peter. Keep those questions coming, and I encourage everyone in the audience to submit some questions as well. But the question is, are there any insights on acquisitions in the oil and gas space currently? Anybody?
You know, we don't really have experience in that area, Lou. All I can tell you is we've had some investors who are in the oil and gas space who are going to invest in some other deals that, based on what's happened in that marketplace, you know, their liquidity has changed significantly. So, but we're not ones who kind of done deals there.
Okay. Anybody come?
I don't have a lot of experience in that space either.
No. And Glenn, I would imagine you either.
No, I don't have a lot of experience in that area. Neither does our firm, honestly. But I would recommend that it's a highly specialized area, and I would certainly get some great advisors around you.
Okay. Okay. Excellent. So I don't see any audience questions now. I'm going to ask a couple of questions of our panelists. If you look at the title of this presentation, it's Exploring Growth Through Acquisition. And when we contemplated doing this webinar, we thought that this would be a really good webinar for a strategic investor that perhaps has been running a company 10 years, 15 years, and is contemplating doing an acquisition and really has very little experience in acquisition. One of the things that we're seeing with COVID is that little by little, we've gone from a seller's market to a buyer's market. In fact, on a weekly basis, we're receiving a lot of phone calls from buyers looking at many of the deals that we are or engagements that we are representing. And so I want to ask some questions along the lines of, what advice would you give to our audience regarding sourcing deals and actually financing the deals, right? Since obviously it's one thing to be interested in doing an acquisition, it's quite another thing to find companies and then to finance them. So we could take the first one. Anthony, I know we have a corporate acquisitions program. Not that we're going to pitch that program, but can you talk a little bit about what some of the people in the audience could be doing to source deals in general and in this environment in particular? Yeah,
well, I mean, I think you have to realize that given the current environment, we are seeing a ton of activity from people who are buyers in almost every industry, but especially in the service side of the business, because they feel that those are areas that basically continue and haven't been affected as much with the whole COVID thing. I think the second thing is they feel that there are going to be some values and some bargains out there to actually be had. So, if you're someone who, for instance, if you're a business owner or you are in touch with a business owner who has a business that's maybe perhaps up for maybe acquisition, or someone who may be considering that, I would say, look, just make sure they get their house in order, make sure that they have their financials in order, make sure they're ready, because you never know when the opportunity is going to come. And here's a quick example. So we have a janitorial supply company, and that person's been looking for forever in terms of acquisitions, but they see a great opportunity now because they are well supplied, well stocked, well capitalized. They see an industry where some of the possible acquisitions are having decent years, but still struggling with cash flow, even though janitorial supplies are necessary. And what they have done is they have aggressively gone out after that marketplace. So I think if you are sourcing something, look at the marketplace, see who you think would be perhaps a good candidate for acquisition. And if they are, then perhaps help those folks get ready in a short time. This way, when somebody knocks on their door, they're kind of ready to go.
Excellent. Pattie, do you come across any instances where you have an opportunity to help clients source deals, or any insights that you could share? Or do they usually come to you?
They usually come to me after they have had their deal sourced. So I don't know how much I can add, but in this particular time, as far as COVID is concerned, I would just say that look for companies that have not been impacted by COVID, because if the company is impacted, you're going to have a very, very difficult time finding a lender that will lend. There are plenty of companies out there that are actually making more money now. For example, HVAC companies, cleaning services, companies like that, that are really, really profitable. And those are the companies that you should be looking to buy now.
Excellent. And Glenn?
We don't often get involved in sourcing an opportunity or finding a target. Mostly clients come to us with targets in mind. But I would say this, that we have many companies, mature companies, that are going the other way, that are looking to sell, and we do get involved in making them ready, helping them and assisting them with improving their bottom line, creating financial statements that are something that is representative of their company and can be relied on by a potential buyer. So, but on the other side, we don't really go out and source for our clients.
Okay. So when I contemplated this question, I thought of a few things, because I get many calls on a weekly basis from buyers that are calling me to see if I have something in their space or in their industry or in their geography. And often what I tell them is, as Anthony said, one of the first things they can do is to take a look at who their competitors are. They probably have run into them through the years, and those are potential good acquisition candidates. If you're involved in an association, many of them continue to have like their annual meetings. Many have gone virtual, so they're actually pretty easy to attend, and it gives you a sense of who the major acquirers in that space are. Regardless of what industry you're in many of the industries in the lower middle market that you would see business broker M&A advisor representing are in fragmented industries that have received interest from private equity groups and family offices throughout the years. And it's pretty easy to take a look at who some of those private equity groups and family offices are, and those might be initial conversations. You also, in my opinion, should be reaching out to intermediaries, M&A advisors, and business brokers, and trying to get a sense of what deals do they currently have. Because when you contemplate an acquisition, you could either approach a buyer directly, you could buy them because they're being represented by a broker or another type of intermediary. And often that's a good acquisition for you as well, because usually the seller is paying the commission. You don't have to pay it. And then thirdly, you could actually strike an agreement with a business brokerage firm, investment bank, or M&A firm, where they would do a buy-side search for you, either one where that has a search fee or not a search fee. But and then lastly, you could also look at the different online databases that source deals. BizBuySell is one of the biggest ones, BizQuest. What that does for you is it gives you a sense of who's active in the market, who the other brokers are. And then lastly, a couple of my partners belong to the IBBA, that stands for International Business Brokers Association. Some belong to M&A Source, which is the M&A division of IBBA. And then Anthony and I belong to the Alliance of Merger and Acquisitions Advisor, and I believe Pattie does as well. Collectively, those three organizations are very heavily involved in the lower middle market, and you should see a lot of intermediaries that are in that space. The beauty of those organizations, too, by the way, is that it also gives you, you'll get introductions into all of the other members of the M&A team. So you'll get to meet some accountants, some attorneys, financial advisors, and so on. And those are the very people that you'll need on the team. So with that said, by the way, I'd like to pivot a little bit to ask a question of our panelists that contemplates things from their perspective. And my particular question is, how could the audience members best work with your particular firm and your particular specialty? And Pattie, for you, I'll ask you a specific question. Why is SBA financing the best form of financing for business acquisition loans, in your opinion?
Because typically when you have a business acquisition loan, you're financing a lot of goodwill. And traditional financing will not finance goodwill. They will require one-to-one collateral coverage, which means for every dollar that they lend out, they're going to require you to have a dollar in asset. But SBA financing allows for the financing of a lot of goodwill. So necessarily, you don't have to have the one-to-one collateral coverage. SBA does require that if there is collateral and all assets be taken, but if there isn't, that's not really a reason to turn the loan down. As far as First Bank is concerned, we pretty much follow that. We're cash flow lenders. So we look for the cash flow of the business to service our debt. And we don't look at or don't necessarily require collateral in order to provide financing for an acquisition loan.
Okay, excellent. And what is the typical structure in the terms for an SBA loan?
It's 10-year fully amortizing, so it's 10-10. And we will finance up to 90%. And sometimes, as I indicated, if the cash flow and synergies are strong enough, we will finance up to 100% for the growth through acquisitions.
Okay, and the current environment, what is happening with the interest payments on the SBA loans?
Really, for an acquisition loan, it's prime, which is 3.25% today. They typically prime plus 2.25% to 275. That's really the range that SBA 7A acquisitions loans trade for.
But is there a benefit to getting the loan before September?
Yes, absolutely. So the CARES Act says that if you close an SBA 7A loan by September 27th, that your principals and interest will be paid for 6 months. So it's free money. And it's really, really great program. I suggest everyone take advantage of it if you can, but just know that you have to close by September 27th, and hopefully the funds will not run out before then. And typically the time for an SBA loan is about 60 days. So if you want to take advantage of that program, you should get started immediately.
Excellent, excellent. I'm going to go back to a couple of questions from Peter again. The first is, how is COVID impacting acquisitions and financing for the same?
I would think I should probably start on that one. And as I indicated, it's really impacting it negatively because it's making the companies not very stable, right? So a lot of the companies are showing losses. A lot of companies have had to shut down. And when you're showing losses, that's the worst time that you could potentially ask for a loan. So a lot of banks will not provide financing for a business that's impacted by COVID until they bounce back and they show that they have recovered from it.
Okay, excellent. Anthony?
So, I mean, COVID has really been, for the most part, a game changer with a lot of transactions and acquisitions and financing. So, with every deal that we have in place, there's been a renegotiation of terms or kind of a look forward to say, maybe we need some sort of earnout. Some of the investors are a little bit skittish. A lot of our deals are non-SBA deals, which have private investment or private equity money. And since a lot of the private equity money was used for the platform companies, some of that is just coming back into the marketplace, kind of fund the deals. And they're taking a hard look at it and saying, maybe we need to kind of reallocate what kind of cash we're going to put as a kind of a cash infusion. And maybe we need more of an earnout or more of a future look and see what earnings are going to be. I think it's impacted it, pretty severely. And however, most experts, if there are experts, because this has never happened before, right? Think probably by the third or fourth quarter this year, we may straighten out. We still see a lot of activity. So the one thing I don't want to miss is you know, when folks are doing an acquisition, we did a transaction, a pretty large transaction that the platform company, which was a private equity firm, had their eyes on selling that firm up to a multiple of 10 to 12 in the marketplace. So they were willing to pay a higher multiple to buy an existing company that we represented. So they look at the accretive value. And you know, I think some of that can overcome some of the ills of any kind of deal. You got to look at that. So this company paid a multiple of 6 for a company that ultimately is part of a company that they're going to sell for a multiple of 10 or 12. So I think, hey, let's look at the big picture too. The finance component of it is the money I think will be available. I think we have a short-term little gap to fill.
Yeah. And Glenn, what are you seeing in terms of the impact that COVID is having either on acquisitions of clients that your firm is representing? I'm not sure if you handle M&A for your firm, or even as a former buyer, what are, in your view, how is COVID impacting your decision to maybe make an acquisition in the future?
Well, it's certainly making projections more difficult. Also, there are other reporting requirements today under COVID. It's certainly, you do need to look and see whether or not you have a going concern issue, frankly. I would also add that there are people in the marketplace looking for opportunities, right? They're looking for distressed companies today. So you know, it's actually, there's a lot of opportunity in the market, and there are a lot of people out there trying to find distressed opportunities.
That was excellent. That's actually Peter's next question. Any thoughts on buying distressed companies? Any thoughts from you guys?
You know, Lou, I think there certainly will be opportunities out there. I think you have to evaluate them like you evaluate any company and be very careful, because, you know, some are distressed and some are not salvageable. So you have to really be careful in terms of what you're buying. If there are specific markets that you want to enter or specific product lines that you're looking for, I think a distressed company could be useful. I think just for the sake of looking for a company, it probably would not make any sense. So I think your decision process has to be no different than what it would be to buy a non-distressed company. The only difference, of course, would be you know, what you think the future for that company is, what the terms and conditions will be under which you buy it, so you can get a bargain that way. But remember that, you know, if you are taking on probably a significant amount of risk, and risk is really what kind of comes back to haunt you.
Okay, excellent. And Pattie?
I was just going to say that it's going to be very difficult finding financing for a distressed company. So if you find a distressed company, be prepared to either pay cash for it or try to get investors to buy it, because it'll be very difficult to find financing for it through a bank.
Okay, excellent. Along those lines, Pattie, what are some of the most common reasons that deals become SBA ineligible?
One that I indicated before is that the seller staying gone for more than a year. So the seller is not allowed to remain in the business after a year. That's one of the biggest ones we see. Another one is an earnout. Earnouts are not allowed through the SBA. And the reason for that is that the SBA and the bank wants to know exactly what the purchase price of the company is and how much the company is going to be paying out. So if there's an open-ended earnout, you don't know how much the company is going to be paying out and how that's going to affect the cash flow. So those are really one of the most important factors I see that make deals SBA ineligible.
Excellent, excellent. Pattie, can you give us an example of a company that you helped out throughout the years with acquisitions? What made it the process go well? What made it not go well?
Yeah, so I think you know, we had an interesting company that was you know, sometimes it's not in the same industry. Some people want to deploy their resources differently. So we had a waterproofing company that was a pretty well known one that was up on the market. They were ones with real estate that had gone up in value, so the business had to be purchased off the site. And the acquirer actually was somebody in a different industry completely, looking to have a business that was not as seasonal as their existing business. They were a summer-oriented business. So what they ended up doing is acquiring the waterproofing company, merging the two companies on one location, separate companies, separate run, but they got to utilize the existing staffs of both companies to use to service both types of clients. And it was a pretty interesting combination, different than what you would expect, but something that worked out because the owners were smart. They said, you know, we have a business that's really focused in the summer. We need something that's focused in the winter. We know we want a service oriented business. They had one in the summer that was more of a solar installation type business, solar pool heating business, and it actually it worked out nicely. The combined financials for the companies realized some significant savings because they, you know, anything below the line pretty much went away. It was a good situation.
Excellent. And Glenn, you mentioned before you had done 60 acquisitions. Are there any, without revealing any, trade secrets or implicating anybody, are there any that you had a very good experience in, and what characteristics did those have? Or alternatively, you know, what were some that you wish you hadn't done them, or that if you had done them, that you would have maybe altered the way you went about doing them?
You know, actually, I would say that the vast majority have been good experiences. We built a great company with great people, a really deep bench and a good team. So it's all in all been a very positive experience. Certainly, you know, you've had a couple of those that didn't turn out the way you would have hoped. And frankly, those are the ones that you spend most of your days and nights thinking about and hopefully learning from. So I've absolutely had those experiences. And I would say that listen to your gut, because almost every one of those that didn't work out, and there haven't been many, I would say out of 60, maybe 6. But those 6, there were signs while I was negotiating that it was not going to be easy after we consummated a deal, and they could have been avoided. But I would say that early on, I was anxious to get deals done, just like Anthony had alluded to, and maybe I wasn't willing to walk away, and there were some that I should have walked away from. So that's what I would say. Really listen to your gut and your instincts, and you know, whoever you're dealing with and whatever problems you're encountering after the deal, they're just going to really be right in your face. And I would, you know, steer clear.
Excellent. Thank you so much. So I don't see any other questions. I'm going to go through the presentation here. Could you call the slides back up, Karen? I'm sorry, real fast. I want to make a couple of quick announcements before I let the panelists summarize their thoughts. Okay, so I don't see it there, but in general, the NYBB series is every couple of weeks. I'm going to be on a panel discussion on June 30th, where the topic is healthcare, and that will be with Stephen White, who runs a valuation shop. And then on June, that's not the right date there. It's July 8th, it should say. I'm sorry. Anthony's going to do a real life exits webinar, taking a look behind the scenes of the sale from a family-owned businesses. So that concludes our webinar. Before we wrap things up, I'd like each of the panelists to just summarize their thoughts, share any perspective that they have for the audience. Tell us how you can help someone who's interested in doing an acquisition. Anthony?
So real quick, I mean, obviously we're the hunters, right? We could find some of the candidates that may make sense to you, some of the targets. We're good at doing that. We could become your inside M&A department, similar to what maybe a larger company has full-time people doing, and help you grow through acquisition. And you know, sometimes I tell folks too, just be careful. The best deal maybe is the one that you never did, right? So you got to just be careful and tread lightly. We tell folks that even when we're representing them, because we don't want them to make a mistake. And I think there's a great opportunity to grow. And but for those who are cautious and those who have the capital and those who have the wherewithal to do it. You know, it's not for the faint of heart, let's say.
Excellent. Thank you. And Pattie?
Following what Anthony said, I really suggest that buyers not rush into buying a business. Take your time, make sure that it's the right business for you. And if it doesn't happen, it wasn't meant to be. There will be others, I promise you. And I have worked with so many buyers that have been disappointed because they've lost one business after another after another. And in the end, when we ended up financing their final acquisition, they were so happy that the other businesses didn't work out because this was a better fit for them. So that's my number one advice. Number two, I want to make everyone wary about companies that say that they have been SBA pre-qualified. That typically doesn't mean much. What that means for most banks is that someone's looked at the deal and said that, yes, it is SBA eligible. However, our bank and myself in particular, what we do when we pre-qualify a loan, we actually go to our credit administrator and we ask the credit administrator, given these parameters, we do a full write-up and are you interested in doing the loan? So if the credit administrator says yes, that is the only time we issue an LOI to for the business. And our LOIs are ran past our credit administrator, and unless something we find out in underwriting that we didn't know before pops up that we didn't know, then the deal will be financed. So you could rest assured that when we provide an LOI to you, it actually means something. And that's really, really assuring to know that we'll do your deal unless we find out something that you didn't know and we didn't know.
Excellent. And Glenn?
So I would say put an experienced team around you. If there's a broker that you're working with, make sure that they've done many deals. Get a good attorney, an attorney that specifically works in the M&A space. If you need financing, I would suggest, I've been listening to Pattie, and she seems to really know her business. I would reach out to Pattie, but make sure that you have a good financial team around you. CPAs that are not just on the numbers side, but also on the advisory side. And that'll really help because you're walking down a path that it takes a lot, and it takes a lot out of you, and it's a real shock to the organization. And frankly, getting the deal done is easy. What we haven't really talked about is what happens after you do the deal, and integrating companies, and that's very difficult. And the better the advisors you have around you, and the better the prep. It's kind of like painting a wall. You tape the wall first. You tape it well, painting's easy. So get those advisors, start out of the box, and then afterwards you'll sail through it. Those are my final thoughts.
Excellent. Thank you so much. That concludes our webinar. I'd like to thank Pattie, Anthony, and Glenn, and thank you as well, and look forward to seeing you in future webinars. Have a good day.
Thank you.
Thank you, guys.
Thank you.
Thank you for having us.